And I will be chatting with Christopher Lin. He's the manager at Fidelity OTC portfolio, which big cap tech, is that correct? Is that
doesn't necessarily
general
have
character?
big cap, and it's about half tech.
Got it. And it's about half tech.
Yeah.
Okay. Well, thanks everyone, and thanks Howard for the introduction and the slides. And we're going to talk a little. I think right now one of the big questions in markets is about what's going on with tech stocks, and I'm very interested in hearing Chris's framework for how he thinks about this question, because his fund has done really well. And so, it's one thing to have an opinion, but it's more interesting to hear how someone even thinks about approaching the problem. So looking forward to this. But tell us a little bit about your background, how you got into this position, how you sort of got to where you're managing this money.
Sure, thanks everybody. So I've been at Fidelity for about 15 years. I started back in 2003. I was actually a healthcare and specifically a biotech analyst for about 5 years. Absolutely loved it. My dad is a professor of biology, and so that was very interesting to me. And then in 2008, I rotated over to the tech team right in time to see the entire market fall apart. So that was really fun. And I covered a lot of hard tech, so physical tech like semiconductors, semiconductor equipment, and a lot of that hardware value chain. In 2013, I went over to do large cap internet, and that has been really fun, have learned a tremendous amount. And so I've been running a couple of tech funds for about 10 years or so. Most recently, I was running our hardware fund and a mid-cap tech fund, and I also have had this tech generalist role for about 5 years as well, and then most recently have been the co-manager on the OTC fund. I run that with my friend and mentor, Sunu Kalra, who has been a great friend and mentor for me for many, many years.
So you talked about how you started in this current role around 2013, and one of the things that I kind of always blows my mind is that when we talk about these huge tech giants that we all know, their ascendance seems like it was preordained, and of course they were going to dominate the world the way they do. But even as recently as 2013, or maybe even 2014 or 2015, it wasn't quite so obvious, was it?
No, and this is the thing, is hindsight's always 2020, and we always forget how much hindsight bias there was. But so back in 2013, I guess that and so I might say we a couple of times, but generally speaking, I don't speak for all of Fidelity. I had a view that this internet thing was kind of going to be a big deal. And we had seen that probably about 15 years earlier. And part B of that thesis was we thought that if it was going to be a big deal, the big would get bigger. And the important thing to know is this was not really obvious. At least to me, it wasn't at the time. And so we think that it's really obvious at this point, but at the time there was quite a bit of risk and uncertainty in that thesis. And part A of that was something that I recognized that I could have been very, very wrong on, and the timing of which was going to be very, very unpredictable as well too. So it was a pretty big bet, but understanding that there was quite a bit of downside to it, and people can say that it seemed very clear then, but it definitely was not at the time for me.
Why did you think the big were going to get bigger? Because people were talking about the long tail, about how on the internet all incumbents were just necessarily roadkill, and there was always going to be this sort of churn of new startups and Web 2.0 sort of disrupting everything or decentralized. What was it about the view at the time that caused you to think that the big were going to get bigger? Because obviously that was one of the that's been a huge moneymaker if you had that view a few years ago. And what was the overall framework that you applied to the situation that allowed you to arrive at that conclusion?
Yeah, so it was really as straightforward as just thinking about a lot of the economics that I had studied for many, many years, and knowing that there were really powerful network effects that were driving the business. And so I think I got kind of lucky in the sense that that was the angle with which I happened to have my background kind of grounded in. And so that's the frame with which I actually approached the sector. And so I thought there would be very, very large economies of scale, both on the demand and the supply side. And that was really the heart of how I kind of viewed them all. But again, I would say that I had a little bit more confidence that the big would get bigger if the internet were going to be taking off. But at the same time, that contingency that the internet was going to be kind of a transformational technology for today was something that was a little bit more uncertain.
Do you think even as recently as 5 or 6 years ago, the trajectory of the internet overall, let alone the big companies we always talk about, was less certain than we feel it was today?
Yeah, I mean, we talk about the giants and just doing Howard's presentation and just listening to that. It just seems very obvious now, and that's kind of the easy decision to make for knowing something after or kind of talking about it after you've seen a little bit of inkling. But back in 2013, like Google was actually trading at a market multiple. People were actually not very optimistic on it because it was sort of a proxy for the overall economy and economic activity, since a lot of the searches that you're doing are actually inherently commercial, and so there was actually quite a bit of uncertainty at the time. Yeah.
One of the things that Howard said in his presentation right at the beginning is that passive investing is a myth. And I don't really totally know what that means or believe it, but it's a good line. It's a good line. And there's obviously for investors a question of, well, why invest in an actively managed fund versus what appears to be some sort of more passive vehicle where you're just like, okay, buy the QQQs for tech exposure or SPY for fluctuating tech exposure. Tell us about your case for active management, because obviously you have a view on it, and how what you do on a day-to-day basis is something of value that people should pay for.
Sure. So I'm not biased whatsoever in the answer to this question, obviously. But no, I love active management. And so to me, it's my dream job from the perspective of getting to learn for a living. And if one can really adequately apply those learnings, then the shareholders can really see a lot of benefit. And so I've always been very interested in analysis, and this is pretty much what the job is. And then understanding a lot of the market sentiment and the temperament behind that, I think, is very powerful too. And so I think the answer to your second part of your question is really kind of in the results themselves. So the results for Fidelity, at least for the last 10 to 20 years, have been pretty solid, and it's not going to beat in 100% of the year as a firm, but overall, the results have been pretty consistently very good, and so I think that what we're doing right now seems to be working.
Results aside, you go into the office, you evaluate your positions, you evaluate theoretical other positions. What is the process that people are paying for?
Yeah, so we have really, I think one of the largest, if not the largest, army of analysts for any actively managed product. I think we have roughly around 130 analysts and 50 portfolio managers who are scouring the planet for ideas every single day to flip over as many rocks as possible. So one of the things that I like to say, and I'm sort of a student of Warren Buffett as well, is that you have no paid strikes you have no paid strikes in investing. So there are errors of omission and there are errors of commission, and both can be very painful, and sometimes they're asymmetric as well. But flipping over as many rocks as possible is half the game, because just seeing it doesn't mean that you actually have to invest in it. But if you don't see it, then you never had the opportunity to begin with. And so a lot of people like to think about errors of commission, which is when you actually take an action and that action is incorrect. But you have to also think about errors of omission, which is when you don't do something and it's very costly, such as Howard mentioned, like not having invested in Amazon or Google or something like that for the past 5 years. And so that's the process by which we have really built our business on, is very bottoms-up, fundamental analysis and stock picking, and then the product being delivered being one of our mutual funds.
This question of the errors of omission, I always feel like it's kind of hanging out there in discussions with investors, because on the one hand, like, yeah, if you had invested in Amazon, then sure, you've had a phenomenal several years. But on the other hand, if you hadn't, there's almost like no way to have outperformed the market, or you miss a couple of those and you're totally screwed. How much anxiety does that produce, the fact that your success as a fund could really come down to one call like that, one underexposure to one company?
Yeah, so it's a good question, and there's a lot baked in there. And the fact of the matter is, in a rising market, like something you've seen for the past 10 years or something, a lot of times, and it depends on your business model. So for example, a VC business model, the errors of omission are actually by far the most painful. Like you do not want to miss the next Uber. That is very, very painful, especially for your business model, since that is actually how a lot of those funds make money. But we also have lived in an environment for the last 10 years where everything has sort of gone up and to the right too. So it's a little bit environmental as well. But there's no question that you have a very skewed or power distribution in terms of returns. And so if you miss the big ones, that hurts a lot. Or if you, if your big bets just don't pay off, that really does hurt a lot, very, very non-uniformly.
So you have all these analysts out there, they're turning over all these rocks, hoping to find the next Amazon or whatever it is. Someone brings you something. What's then next? What are the key things? In this economy, with this nature of the tech industry, what are you stress testing for to look for a company that'll make it?
Yeah, I mean, I don't think it really changes that much necessarily depending on what the market has done, but the process is conceptually pretty consistent, which is we are just going to look to see if something is undervalued. And so I'm not necessarily looking for the best company or the fastest growing company or anything like that. I'm looking for the most mispriced security more than anything else. And so the market expectations do have a lot to do with that. But I think that the idea is still very consistent no matter what the market's actually doing.
You know, Howard showed that chart of Netflix and its valuation, and I'm not going to ask, you know, what you think about Netflix, but per se, but it does show, I mean, that's a stock that's driven people insane because traditional metrics probably would not have put you in there. Amazon is another one where if you adhered too close to sort of the old school Graham and Dodd style of investing, a lot of these companies, I think, are like that, would have driven people insane. And so when you say undervalued, what are the parameters that you use to determine what fair value is for anything like these companies?
Yeah, so great question. This is probably the most frequent question I get as a tech investor / growth investor. And to me, the value of any asset is the amount of cash that you can get out of it over the duration or life of that asset, discounted to today, full stop. There's no complication or anything beyond that, in my humble opinion. However, the bet that we are oftentimes willing to make is that we are willing to bet on future cash flows. You know, it's not necessarily the strategy that everybody has, but it's one that we are willing to make on a risk-adjusted basis. And so a lot of people like to kind of frame this as the growth versus the value dichotomy. And I actually view growth and value as two sides of the same coin. Like, I've never bought or recommended a stock that I thought was really expensive. And so it might look expensive based on a lot of the traditional metrics that we think about, like earnings ratio or price to tangible book value or anything like that. But when you have companies that have no tangible book value because they're actually not even physical whatsoever, yet they might have still very, very economically valuable relationships with customers who value the product, then we are absolutely willing to make a bet on the future cash flows of the company. And I think, as Howard said, I think a market is as well sometimes. And so I think there's price, there's value, and there's sort of the realization of value. And you kind of have to have all three to make money. And I think where a lot of people get tripped up is sometimes in that last part, whereby there's that realization of value, which can really drive a lot of people insane. And so the short answer is we are definitely willing to look out in the future to think about what the cash flow stream is going to look like in several years.
I'm glad you said that, because I have to say, I tweeted this a number of times. I've never understood what a value stock is per se, because I don't understand the idea of buying something that one wouldn't consider a value stock. So I'm glad to hear that you think that the growth value dichotomy is sort of a false one.
Yeah, I mean, that's just one man's opinion, but I think of all stocks that I want to buy as value stocks.
Let's talk about, you know, network effects, and Howard mentioned it, and I think that obviously you can't have, there's no discussion here today that won't somehow implicitly be about the power of networks and the power of network effects. At some point, in theory, they can erode. We've seen in the past, we've seen what seemed like powerful networks collapse. What are the signs that you look for? And I think probably a lot of people these days are wondering about the durability of some of these network effects. What are the signs that you look for that, okay, here's this really powerful network, maybe it doesn't have the sort of lock-in or power that it once had?
I mean, I don't know if it's necessarily something that's quantifiable or measurable or tangible like that, but I think it would be something that probably each and every one of y'all would find intuitive, which is just how much are people actually engaging with a particular network or platform, because the less it's actually integrated in your life, then the more fragile it is. And the interesting about network effects is, I will sometimes say, they can be your best friend, but they can also be your worst enemy when it completely unwinds. Facebook and MySpace or Friendster was a classic example of a one-sided network effect, whereby those have the potential to be the fastest on the way up, but also the fastest on the way down as well. And so I don't necessarily think of like, oh, I'm like counting the number of nodes, although that can be a reflection of the fragility or the stability of the network, but also the number of connections per node, if I were to think about it mathematically. But oftentimes it's not as scientific, but more about how much it's actually integrated into people's lives.
But once the downside begins, what seemed like a lock-in can unravel really fast.
Completely. I mean, you can see this for everything around you, whereby something can just kind of shoot up and then unwind just as rapidly and fall down like a house of cards.
One of the other angles, I guess, on this is the fear that networks can become too powerful and draw the ire of regulators, and people say, you know, this is monopoly or something like that. We got to put a stop to this. How do you think about those risks?
Well, this is obviously a very timely question, but the fact of the matter is it's true. So when you actually have powerful networks and you combine them with low marginal costs, so you might have had a lot of fixed costs up front to kind of see the network, and then with very marginal costs afterwards, there's sort of an almost unfair economic sort of playing field, whereby it's just so much easier for the big to get bigger. And this was actually the premise for how we thought about it, you know, how I thought about it 5 years ago. And now we are now wondering, the world is now wondering whether or not they've, you know, been a little bit too aggressive and flown too close to the sun, and to what extent are they now flirting with having to be more responsible for their impacts on society, and not just being one single platform or tool, but just having large externalities on actually how people are living their lives. They can no longer just kind of think about themselves insularly, but actually have to think about some of the ramifications for the other industries too. But it's actually a question that I think doesn't really have a solid answer at this point. You're asking tough questions that aren't necessarily easily answerable. And I think the regulators are actually having a tough time with it too.
Well, in terms of the risk, I do think it's sort of a conventional wisdom, or it's sort of the obvious thing that, okay, regulatory risk looms out there. Now, whether there's going to be any teeth to the regulation, very big question, but it's out there. But then on the other hand, and that people dismiss the idea of organic competition, or maybe people dismiss the idea that there could be just another entity that does to Facebook what Facebook did to MySpace. Are people overly discounting that second scenario in which real competition just emerges and sort of breaks through the cracks?
Yeah, so this is the delicate balance that I think the politicians understand quite well. Is there are a couple of things. One is, it's not anti-competitive to have competed your way to a very, very monopolistic position. What is not allowed is using that market power to be anti-competitive and therefore not allow other people to compete whatsoever. That's sort of the first sort of balance. The second thing is, I think the regulators seem, at least from what I've seen on television, is keenly aware of the fact that they want to make sure that they're not too heavy-handed in stifling the next Facebook, the next Google. And so if they were to impose legal structure around, let's call it broadly, the internet today, to what extent would that stifle innovation in the future? And I've been impressed actually that they are very keenly aware of that, and they really do want the market to be able to sort it out kind of as their first option, it seems like.
And do you think that the current market environment is such that a competitor to Facebook or a competitor to Amazon could emerge organically at this point?
I'm not sure how far I want to go down that, but I would say it's definitely possible. I mean, the theme probably for the last 9 months has been decentralization, right? Which is very, very interesting, actually. And so I think there's a lot of merit to seeing that be able to, once again, disrupt the disruptors.
All right, well, I like the fact that you brought it back to that sort of fundamental question. Christopher Lin of Fidelity, thank you very much. It was great.
Cool.